Julia ceases to be an Australian resident when she establishes a permanent place of abode in New York for the foreseeable future. She retains ownership of her Melbourne house and some ANZ Bank shares, which are listed on the Australian Securities Exchange. Julia would like to know about her potential CGT liabilities regarding her shares and Melbourne house. In general, a non-resident is assessable on Australian source income. However, in some cases, income might be assessable on the basis other than source. The CGT provisions assess non-residents on the basis other than source. Specifically, non-residents are potentially assessable for CGT events relating to taxable Australian property. The legislation lists 5 categories of assets that are taxable Australian property. Taxable Australian real property refers to real estate located in Australia, such as a Sydney house or apartment. It also includes mining and related rights where the minerals are located in Australia. Indirect Australian real property interests generally refer to interest in another entity, such as shares in a company where 2 conditions are fulfilled. Firstly, the non-resident owning the interest in the entity must own at least 10% of the entity. As such, this first condition is unlikely to be met in the case of small holdings of listed entities. Secondly, the majority of the assets by market value of the entity owned by the non-resident must be taxable Australian property. For instance, shares in a company where 60% of the company's assets are Australian property would fulfill this second requirement. The third type of taxable Australian property is where a CGT asset has been used in carrying on a business through a permanent establishment located in Australia. For instance, the assets of an Australian branch of a foreign company would fall into this category. The fourth type of taxable Australian property is where the taxpayer has an option to acquire any of the prior 3 categories. So, an option to acquire real estate in Australia, an option to acquire an indirect real property interest in Australia, or an option to acquire a CGT asset used in an Australian branch of a foreign company. Taxable Australian property also exists where an individual taxpayer has elected to treat a CGT asset as taxable Australian property under CGT Event R1. CGT Event R1 applies where an individual who was formerly an Australian resident for tax purposes ceases to be an Australian resident. That is, they no longer satisfy any of the residency tests. Due to CGT Event R1, CGT is payable on assets that are not taxable Australian property at the time the taxpayer ceases to be an Australian resident. For example, CGT would be payable on a small shareholding in an Australian company, as the CGT asset would not meet the definition of taxable Australian property. In this case, a capital gain or loss would be based on the market value of the asset at the time the taxpayer becomes a non-resident. However, the taxpayer may elect not to have CGT Event R1 trigger CGT liability at the time they become a non-resident. Instead, they can choose for their non-taxable Australian property, such as a small holding in an Australian company, to be deemed to be taxable Australian property. In such situations, the CGT liability is deferred until a later CGT event happens with respect to the asset. This defers any tax payable, but note that the taxpayer will instead be subject to higher non-residence tax rates in Australia and will not be entitled to the full CGT discount. In Julia's case, her Melbourne house is real estate in Australia, so it is clearly taxable Australian property. She will potentially be liable to pay CGT when this house is later sold. However, ANZ Bank shares are not inherently taxable Australian property, as they are not regarded as indirect Australian real property interests. They would only be indirect Australian real property interests if Julia owned at least 10% of ANZ, and the majority of ANZ's assets were taxable Australian property, such as Australian real estate. Here, neither of these conditions are fulfilled. Since the ANZ shares are not taxable Australian property, Julia could choose to pay CGT on them when she loses residency due to CGT event R1 being triggered. Alternatively, Julia could choose for them to be deemed to be taxable Australian property, in which case any CGT liability will be deferred until a future CGT event happens to them. The decision will likely be one of personal preference and circumstances, such as what the taxpayer's net capital gain or loss is, whether they have the cash flow to pay any resulting tax, what they intend to do with the CGT asset, and how the CGT asset and its disposal will subsequently be taxed. To recap, if a non-resident holds taxable Australian property, such as a house in Sydney, a CGT liability will only arise when such assets are subject to a CGT event. If a non-resident holds non-taxable Australian property, such as a small holding of listed shares, no CGT liability will arise. If a resident becomes a non-resident and holds taxable Australian property, such as a house in Sydney, no CGT liability arises until the time that a future CGT event occurs to the asset. If a resident becomes a non-resident and holds non-taxable Australian property, such as a small holding of listed shares, CGT event R1 occurs and CGT liability arises, subject to the taxpayer instead electing to treat the asset as taxable Australian property and deferring any CGT liability until a future CGT event occurs.